I think that there were vulnerabilities that existed under the system, and the COVID is a stress test and it'll go away. But there'll be some things that are broken for a long time, and then there's some things that are profoundly changed. I think, first of all, the financial gaps between entities is clear. The rich, the poor, those who have good income statements and good balance sheets, and those has been a defining characteristics. Some of those will be broken, and it has enormous political consequences. The left and the right will be, I think, in greater conflict. And so that issue has also been connected to the changes in money and credit. In other words, before that, interest rates hit zero and there was not classic monetary policy. And also when there was QE, it didn't pass through to those who needed the money the most. And we're in a new era in which there's going to be government borrowing money and directing that money more than the normal capital markets, and central banks buying money. And that is going to have a profound impact on the value of money, probably reserve currencies and so on. And then related to that is it's a defining moment in terms of the strong and the weak, which, for example, China has come out of this very well, and it's going to change the nature of capital flows, I think. So I think that it'll have political and wealth implications that will be very important and will be clarified over the next, I think, 2 years. I think that this is a good summary. I think when I look at history, I've studied the rise and decline of reserve currencies over the last 500 years. And this is a moment of a change in the world order, very similar to that which happened prior to World War I, prior to World War II. An analogous period. There's large wealth gaps and income gaps and opportunity gaps that exist. There's no time that has been this large since the 1930s. At the same time, monetary policy and debt policies in which when you have a zero interest rate, there needs to be the expansion of debt and that monetization of debt. That last time that happened like this to this grade was 1930 to 45 period. And the rising power of China challenging an existing power in its competitions. The last time that existed was in the 1930s to 45 period. There are struggles, fights over wealth and political power within countries and then between countries. That confrontation, that issue about how to deal with that, whether it's in a peaceful way or in a confrontational way within countries, like our political divide and our social divide that exists in the United States and in many countries, or between countries, such as the conflicts that exist between the United States world order and the Chinese rise, in which there's a trade war, a technology war, a geopolitical war, and even a capital war now, and then there's military conflict. We, I believe, are coming into a more challenging environment because of the nature of how this happens over and over again through history in these cycles. So I think that this is a defining moment of how we're going to be with each other, internally within countries and externally. But we're still going to have to face the problems of how do you create money and credit, and how do you get it into the hands of those people who need it most. So I think that the summary is completely right, and I hope that we follow that better direction. I'd like to emphasize the portfolio because I think that's probably most relevant to other people. There's a period of, I think, great uncertainty and great risk. And so I think there are three words: diversification, liquidity, and then differentiation. We want to make sure that our investors are not just concentrated in some of the traditional markets. So diversification of how to do that well can reduce risk without reducing opportunity. And that means currency diversification, including the reserve currencies, how much exposure is to the reserve currencies, but it means currency diversification, asset class diversification, country diversification, and that should be the starting point of portfolios. In terms of liquidity, it allows you the flexibility to change as circumstances change. And differentiation is the most important consideration now. There are two different worlds. There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it. And that differentiation versus other worlds and markets related to that, that will be bankrupt and disorderly. That kind of differentiation is important. As far as the business goes, we have, the different location considerations and long relationships that we're building on. You could see it. It's reflected in the income statements and balance sheet. Every individual, every company, every country, how well they are depends on how much their income is relative to their expenses and how much their assets are relative to their liabilities. So you can see radical differences in the financial consequences of that. Second, the proximity to those who are printing and distributing money. Are you a recipient of that? For example, a lot of the third world is not a recipient of that and is not in good financial situations. And then there's order, political and also social order. So when you could see it differentiated in the countries that are controlling the virus and behaving orderly and well together. So you could see those differentiations reflected in the market's behavior, and you can also see it reflected in the political and social conditions. When we look at interest rate market, we look at the earnings yield. When we look at stocks and we look at PEs, they're basically yields. And the capacity of central banks to print money and buy financial assets has essentially led the bond market to go to multiples that are somewhere between 100 times. You put $1 out and you'll get your money back in 100 years. So it's as 100-time multiple. You have to compare stock multiples to bond multiples. And so the capacity of central banks to put liquidity into the system and to have that liquidity go to produce high multiples is very real. It also changes the economics of borrowing. In other words, if you can find something that makes anything more than a zero, or you're going to make money. So that encourages the leveraging and it changes. So the financial flows that we're seeing, the market behavior is reflective of that. In my opinion, don't own bonds and don't own cash because they're producing a lot of debt and producing a lot of money to fund it. And so that's changing the nature of capital flows. It's also changing how those flows go to China in terms of the comparison of that market, particularly as it opens up. So I think it's behaving sensibly, but don't use old multiples as reflections of the limitations of what's expensive.